Welcome to The Explainer. Today, we're going to break down one of the most reliable investment tools out there, Kenyan Treasury Bonds. We'll cut right through the jargon and show you exactly how you can make them work for you. So let's just start with a really big question. Are you looking for a secure, predictable way to grow your savings? Something that offers a steady return without the wild roller coaster ride of the stock market? Well, if that's you, then you are in exactly the right place. Okay, here's what we've got lined up. First, we'll tackle the big idea. What does it mean to lend to the government? Then, we'll get into what a bond actually is. After that, we'll walk you through how to buy one, step by step. We'll weigh the pros and cons, and finally, we'll wrap up with a really smart strategy to get you started. Let's do this! So, first up, lend to your government? So first up, lend to your government. Let's start with the big picture here. See, when you buy a treasury bond, you're not just buying a financial product. You're actually becoming a lender to your own country. So what does that really mean? That's right. The money you invest doesn't just, sit in a vault somewhere. It gets put to work building the nation. We're talking about huge, essential infrastructure projects, the very roads you drive on, the energy that powers your home. It's a pretty direct way to play a part in the country's growth, all while earning a return. All right, section 2. Now that we know why the government is borrowing, let's get into the what. What exactly is a treasury bond? How does this thing actually work?
The easiest way to think about it is this. A bond is just a formal IOU from the government. It's a rock-solid promise. You lend them your money, and in return, they promise two key things. First, to pay you back the full amount on a specific date in the future, that's called the maturity date. And second, to pay you regular interest, which has a fancy name, a coupon, usually every 6 months.
Now, in Kenya, you're mainly going to see two types of bonds. You've got your standard fixed-rate bond, the FXD, which is your predictable, straightforward option. But the one you really, really want to pay attention to is the infrastructure bond, or IFB. Why? Because while both offer a steady, fixed income, the interest you earn from an infrastructure bond is completely tax-free. And let me tell you, that is not a small perk. It's a massive advantage that seriously boosts your total earnings.
All right, section 3, your first purchase. Okay, enough theory. This is the practical, hands-on part you've been waiting for. Let's walk through the exact steps to buy your very first Kenyan Treasury bond.
Honestly, the process is way more straightforward than you might think. It all starts with opening a CDS account. Think of it like a special bank account just for your investments. Then, you just keep an eye out for bond announcements from the central bank. Once you see one you like, you read the prospectus, that's the official document with all the key details, fill out the application form, and send in your payment. Just 5 clear steps, and you're in the market. And I know what you're probably wondering. Okay, so how much cash do I need to get started? Well, the typical minimum investment for everyday investors is 50,000 Kenyan shillings. This makes it a really accessible entry point for anyone who's serious about kicking off their investment journey. Okay, Section 4, Risks versus Rewards. Let's be real, no investment is perfect. So to make a truly smart decision, it's absolutely crucial that we look at both sides of the coin, the really powerful rewards and, yeah, the potential risks too. So here's the trade-off, laid out pretty clearly. The benefits? They're huge. A steady income stream, incredibly low risk of losing your money, and those fantastic tax advantages with the infrastructure bonds. But on the other side, you got to think about the risks. For instance, interest rate risk. That just means if new bonds come out with higher rates, your older, lower rate bonds suddenly looks less attractive. And then there's inflation risk, making sure the return you get actually outpaces the rising cost of living. It's all about balancing that amazing security against these bigger market forces. Okay, last but not least, Section 5, building your strategy. So how do we pull all this together? How can you use bonds not just as a one-time purchase, but as a core part of your long-term financial plan? One of the most effective and, frankly, easiest strategies to understand is called the bond ladder. The idea is simple. Instead of putting all your money into a single long-term bond, you spread it out. You buy several bonds that mature on different dates. You're literally building a ladder with your investments. So here's how it works in practice. Super simple. In year 1, you buy a 2-year bond. In year 2, you buy another 2-year bond. Now watch what happens. In year 3, your first bond matures. You get your money back, and you just reinvest it into a brand new 2-year bond. You do the exact same thing in year 4. And the result? After that initial setup, you've created a system where you have a bond maturing every single year. You've basically built your own little money machine that provides a predictable, continuous stream of cash.
So, as we wrap things up, let's leave you with this thought. By understanding how Treasury bonds work, especially those tax-free infrastructure bonds, you've really unlocked a powerful tool for building wealth safely. So the big question to ask yourself now is, what role could this kind of predictable, reliable, tax-free income play in helping you achieve your biggest financial goals? Think about it.